Let me start with sort of the idea of tangible capital levels. The fact that they may be under some pressure, given obviously the drop in bond prices.
So Leslie,
is that going to be a theme at all?
Yes. Leslie picked on the two quick boxes that we think are going to get checked, which is we think we're in the second of 4 quarters of 20% increase in growth in net interest income. That's about as strong as I've ever seen it in my career. So for a regional bank or the banking business at its core, lots of revenue growth. The two new things that we think investors are going to be really focused on are capital levels, because all these bonds that the banks own get marked to market through the tangible capital line. And so you're going to start to see the industry really levering itself. One, because in the numerator, you got the marks to tangible capital, and we've had a swelling of deposits in the industry, we think to the tune of $3 trillion because of COVID and the relief. I've never seen anything like it in my career. So these deposits are going to be leaving the system as market rates become more competitive. So that's going to be the second question that investors have, which is we're going to see a lot of big banks show deposits shrinking, which is not something that usually happens. It's something that everyone should get ready for. JP Morgan said earlier this year they think they could lose $400 billion over the next year, which in and of itself would be the nation's 10th largest bank. So those are the two themes. And if you look at this tangible common equity to asset ratio, we'll be as levered probably at the end of this quarter as we were at the end of 2007.
All right, so we've got the positives that you also mentioned, of course, is the net interest margin, net interest income growth that we're talking about as we watch rates continue to skyrocket. What's going to win out in the market when we start hearing these numbers?
So I think the first thing is, so what's happening in the industry is the spring's getting a little bit more coiled. And so if you are an individual who has a really bare case of what's going to happen, and that we introduce a big credit recession to the banking industry, which is something that we don't see happening right now. If you believe in the tail risk, you could start to see things like capital raises and steps like that, which would probably protect more of the bearish narrative to it. That's not what we have in our models, and we think there are pockets of the industry where actually the environment is very much okay, and the stocks more than reflect what may happen. So our view is the story of this quarter is that we think the history books are going to say this is the quarter where the spring got a little tighter in terms of balance sheet leverage, and we're going to need to know in the next 6 to 9 months what happens to credit as to how things play out.
Where's the line between natural shrinkage in deposits because people running off their COVID savings and real areas of concern?
Yes. So non-interest-bearing deposits are the crown jewel of banking. So you're going to have the best banks in America are going to grow non-interest-bearing deposits, and they're going to let their rate shopper depositors leave. And if you see the headline number, you may get really nervous that deposits just shrunk. But the reality is the core bank is still very solid. And so those are the things that we're going to look at to see what's happening to the high-quality deposits and let the rate shoppers leave.
Is loan growth going to be a story? And expenses too?
Yes. So loan growth was the big story of the second quarter, where it was close to 20%. It's now normalizing, and it's what you think it would be in a weak economy. We think it's going to be around 7%-ish, and we think it's going to continue to wane. But to get back to your prior question, Carl, it's the loan-to-deposit ratio. When banks get near 100%, investors get nervous. They like to see core deposits funding loans. We're nowhere near there yet.
Right.
We haven't heard anything about liquidity in the banking system, but we've taken a step closer to it with what's happening.
Tom, meanwhile, in near term, I can't remember an earnings season, at least recently, where we had a positive impact, where we had a positive response from the banks, regardless of whether they beat, came in line, or didn't beat. It always seems like the stocks react negatively.
Well, I'll tell you, the biggest boogeyman around banks is credit, okay? And and it's those who are living in the tail risk of what may happen believe that we're going to get a credit cycle. The surprising thing is how low credit costs have been. We're going to get higher credit costs. We got them in our model. I can tell you this is a different industry than it was during the global financial crisis, because we've had the shadow banking industry absorb a lot of this risk. We're all focused on subprime consumer lending right now. I've done a deep dive with our team. A lot of that has left the banking industry. It's in specialty finance companies. It was chased out of banks. So it'll be interesting to see how the different parts of financial services plays out in this new environment.